Welcome back to Stocks and Trades channel. We provide easy to digest information in short videos about stock market investing, personal finance, money saving, and building wealth. Our content is designed to help you achieve financial freedom sooner. Today's video will provide news, insight, and investment suggestions on the week ahead. We'll analyze 2+1 stocks to watch this week and some others that will be volatile. So, let's begin. Disclaimer. All trading involves risk. Only risk capital you are prepared to lose. Past performance is not an indication of future results. This content is for educational or entertainment purposes only and is not investment advice. After recording 2 positive weeks in a row, the major U.S. stock indexes slipped, extending their shaky start to a year that began with 3 consecutive weekly declines. Stocks climbed on Tuesday and Wednesday, only to fall the next 2 days amid renewed concerns about inflation, the pace of monetary tightening, and geopolitical conflict in Ukraine. Prices of stocks and bonds fell on Thursday after the government reported that inflation accelerated at a 7.5% annual rate in January, the highest since 1982. That figure was above December's 7% increase and well above the 1.8% annual rate for inflation in 2019, prior to the pandemic. As it was for full year 2021, energy has been the top performing S&P 500 sector of early 2022 and by a wide margin, with a nearly 24% year-to-date price gain as of Friday. Rising oil prices have been a key reason for energy's recent market leadership. The Bank of Russia on Friday became the latest major central bank to lift interest rates. The move came after Russia's annual inflation rate rose to 8.7% in January, and as the nation faces the threat of Western economic sanctions amid the military face-off on Russia's border with Ukraine. Our first stock type is dividend-earning stocks. These are a great way to earn passive income. This week's suggestion is Chevron Corporation, with ticker symbol CVX. Chevron Corporation is an American multinational energy corporation. One of the successor companies of Standard Oil, it is active in more than 180 countries. Chevron is engaged in every aspect of the oil and natural gas industries, including hydrocarbon exploration and production, refining, marketing and transport, chemicals manufacturing and sales, and power generation. It was also one of the 7 sisters that dominated the global petroleum industry from the mid-1940s to the 1970s. Chevron is one of the largest companies in the world and the second largest oil company in the United States, only behind ExxonMobil. As of August 2021, Chevron ranked 27th in the Fortune 500 with a yearly revenue of $94.7 billion and market valuation of $190 billion. In the 2020 Forbes Global 2000, Chevron was ranked as the 61st largest public company in the world. The company operates in 2 segments, upstream and downstream. The upstream segment is involved in the exploration, development, and production of crude oil and natural gas, processing, liquefaction, transportation, and regasification associated with liquefied natural gas, transportation of crude oil through pipelines, and transportation, storage, and marketing of natural gas, as well as operates a gas-to-liquids plant. The downstream segment engages in refining crude oil into petroleum products, marketing crude oil, refined products, and lubricants, transporting crude oil and refined products through pipeline, marine vessel, motor equipment, and rail car, and manufacturing and marketing commodity petrochemicals, and fuel and lubricant additives, as well as alkylate and plastics for industrial uses. Chevron has production of 3.1 million of barrels of oil equivalent a day, including 7.3 million cubic feet a day of natural gas and 1.9 million of barrels of liquids a day. Production activities take place in North America, South America, Europe, Africa, Asia, and Australia. Its refineries are in the US and Asia for total refining capacity of 1.8 million barrels of oil a day. Proven reserves at year-end 2020 stood at 11.1 billion barrels of oil equivalent, including 6.1 billion barrels of liquids and 29.9 trillion cubic feet of natural gas. The company was founded in 1879 and is headquartered in San Ramon, California. Michael Vierth has been serving as chairman of the board and chief executive officer since February 2018. Some technical analysis data shows that Chevron's return on equity is 7.4%, Its average volume is about 12.36 million, its market cap is $267.58 billion, its beta is 1.17, its PE ratio is 17.05, its PEG ratio is 0.53 and its EPS is $8.14. Our rating is 10 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Chevron in the last 3 months, the average price target is $142.86, with a high estimate of $166 and a low estimate of $109. With current price at $138.81, this would mean about 2.92% average profit over the next year. Chevron pays an annual dividend of $5.44, which amounts to a dividend yield of 3.92% and a dividend growth of 3.88%. The ex-dividend date is the 15th of February, so buying a Chevron stock by then will pay you $1.42 on 10th March. At first glance, Chevron's focus on fossil fuels may appear antiquated as the auto industry's focus is shifting toward electric vehicles. Although Chevron says it's interested in advancing a lower carbon future, its profits still come from oil and natural gas. Nonetheless, according to the U.S. Energy Information Administration, petroleum and natural gas still account for 69% of the country's energy usage. This means Chevron can probably continue generating sufficient cash flows for years to come. Moreover, it has made the necessary investments in finding reserves. This allowed the company to plan its Noble Energy purchase and pay $9.7 billion in dividends in 2020 despite reporting only $1.7 billion in free cash flow that year. The company appears to have recovered from the energy price downturn of 2020 quickly. In 2021, Chevron brought in about $162.5 billion in revenue, 72% more than in 2020. Additionally, it reported a net income of $15.7 billion, which helped it produce a record $21.1 billion in free cash flow for the year. With that much free cash flow, Chevron's $10.2 billion in dividend expenses was no trouble to cover. It holds dividend aristocrat status with a 35-year streak of payout hikes. Amid rising energy prices, Chevron stock has climbed by more than 50% over the last year. Despite that, it still trades at a price-to-earnings ratio of about 17, only slightly higher than the 15 PE ratio of ExxonMobil, which had a tougher time during the first year of the pandemic. Given today's high oil prices and Chevron's attractive dividend, this stock remains an attractive pick. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our second stock type is growth stocks. A growth stock is a share in a business that's shown above average earnings and has the potential to grow faster than the overall economy. This week's suggestion is Salesforce, with ticker symbol CRM. Salesforce is an American cloud-based software company. It provides customer relationship management service and also provides enterprise applications focused on customer service, marketing automation, analytics, and application development. Salesforce's customer relationship management service comprises several broad categories: Commerce Cloud, Sales Cloud, Service Cloud, Data Cloud, Marketing Cloud, Community Cloud, Manufacturing Cloud, Analytics Cloud, App Cloud, Vaccine Cloud, Internet of Things, and Work.com with over 100,000 customers. It provides its services through direct sales, consulting firms, systems integrators, and other partners. Salesforce has a strategic partnership with Siemens and Amazon Web Services Incorporated. The company was founded in 1999 and is headquartered in San Francisco, California. Mark Benioff is chair, co-chief executive officer and co-founder, and Brett Taylor is co-chief executive officer of Salesforce. Some technical analysis data shows that Salesforce's return on equity is 3.5%, its average volume is about 7.04 million, its market cap is $204.78 billion, its beta is 1.07, its PE ratio is 114.36, its EPS is $1.82, and its asset growth is 47.86%. Despite our rating is 8, we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Salesforce in the last 3 months, the average price target is $333.17, with a high estimate of $375 and a low estimate of $225. With current price at $207.90, this would mean about 60.25% average profit over the next year. On February 9, Salesforce co-chief executive officers Mark Benioff and Brett Taylor spoke about the company's vision for an NFT cloud service. NFTs are unique digital assets stored using blockchain technology. It has taken off in the world of art and collectibles, and the company sees an opportunity to bring the technology to its enterprise software. People familiar with the matter say that Salesforce wants to offer a service for artists to create content and release it on a marketplace like OpenSea. Earlier in the month, the company also announced Manufacturing Cloud for Service, a new industry-specific platform built on Service Cloud to automate service processes. With the new service, manufacturers can take advantage of Service Cloud's ability to deliver faster and more personalized service across any channel or device to grow customer loyalty and satisfaction. Today, manufacturers are increasingly managing customers who expect 24/7, omni-channel digital service experiences. They also look for ways to strengthen customer loyalty while also automating customer service and turning it from a cost center into a revenue generator. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our third stock type is blue chip stocks. These are typically large, well-established and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. This week's suggestion is Waste Management, with ticker symbol WM. Waste Management Incorporated is an U.S. headquartered waste management, comprehensive waste, and environmental services company operating in North America. It offers collection services, including picking up and transporting waste and recyclable materials from where it was generated to a transfer station, material recovery facility, or disposal site, and owns, develops, and operates landfill gas to energy facilities in the United States, as well as owns and operates transfer stations. As of December 31, 2020, the company owned or operated 263 solid waste landfills, 5 secure hazardous waste landfills, 103 MRFs, and 348 transfer stations. It also provides materials processing and commodities recycling services, recycling brokerage services, such as managing the marketing of recyclable materials for third parties, and other strategic business solutions. In addition, the company offers construction and remediation services, services related with the disposal of fly ash, and residue generated from the combustion of coal and other fuel stocks, in-plant services comprising full-service waste management solutions and consulting services, and specialized disposal services for oil and gas exploration and production operations. The company was founded in 1968 and is headquartered in Houston, Texas. Jim Fish has served as Waste Management's president since July 2016 and chief executive officer since November 2016. Some technical analysis data shows that Waste Management's return on equity is 23.8%, its average volume is about 1.93 million, its market cap is $59.67 billion, its beta is 0.86, its PE ratio is 33.25, its PEG ratio is 2.46, its EPS is $4.29, and its return on capital is 9.4%. Our rating is 9 and we consider this stock as a moderate buy. Based on experienced analysts offering 12-month price targets for Waste Management in the last 3 months, the average price target is $161.50, with a high estimate of $174 and a low estimate of $152. With current price at $142.64, this implies a 13.22% upside potential over the next year. The company's board of directors has approved a 13% hike in dividend from $0.575 per share to 65 cents per share for 2022. Annually, the dividend will be raised from $2.30 per share to $2.60 per share. Notably, this is the 19th consecutive year that the company has increased its dividend. The company, also, maintained its stock buybacks, approving $1.5 billion for future repurchases. Waste Management is looking to invest heavily in recycling and renewable energy projects in 2022 and beyond, signaling management's vision for the company's future. This news was interpreted differently by various stakeholders, but long-term investors should see this as a positive indicator. It is clear management does not want to sit back on its heels when it comes to sustainability, seeing it instead as a major opportunity. While the expenses to fuel this shift will be costly in the short term, they will not affect the company's ability to return capital to shareholders, nor will they permanently crimp impressive cash flow margins. Waste Management might be a boring stock at first glance, but under the surface lies a cash-generating machine with a management team looking toward the future. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Next week, many companies are going to release their earnings reports, which is one of the most potentially volatile times of the year for equities, and if we are not careful enough, we could put our entire portfolio at risk. Companies may announce earnings or losses and stock prices may go up or down significantly. For this reason, we suggest that you avoid or carefully consider opening a position for the following stocks during next week, and wait to evaluate the earnings announcement before deciding to invest. Arista Networks, Avis Budget Group, Advance Auto Parts, Continental Resources, and Omnicell will release earnings on Monday 14 February. Alibaba Group, Marriott International, Viacom CBS, FIS, and Airbnb will release earnings on Tuesday 15 February. Nvidia Corporation, Cisco Systems, Shopify, British American Tobacco, AIG, and the Kraft Heinz Company will release earnings on Wednesday 16 February. Thursday 17 February will be the most popular day of the week as Walmart, Barclays, Orange, Roku, Baxter International, Palantir Technologies, and Dropbox among others will release their earnings on this day. Finally, John Deere, Eni, PPL Corporation, and NatWest Group will release earnings on Friday 18 February. Watch these stocks' prices carefully and think twice before making any decision. Next week will not be that popular among dividend stocks, but we have some interesting options to suggest. Monday 14 February will be the most popular day of the week and is the ex-dividend date for Enbridge, Amgen, Prudential Financial, Eli Lilly and Company, and Cable One. Tuesday 15 February is the ex-dividend date for Chevron Corporation, Target Corporation, Marathon Petroleum Corporation, Invesco, Aflac, and Consolidated Edison. Wednesday 16 February is the ex-dividend date for Microsoft, Danaos Corporation, and Discover Financial Services. Thursday 17 February is the ex-dividend date for MSCI, Shell, Yum Brands, Walgreens Boots Alliance, PPG Industries, and Duke Energy. Finally, Friday 18 February is the ex-dividend date for Johnson & Johnson, Equifax, Energizer, and UPS. Be sure to buy any of the above stocks before the market closing of the ex-dividends date previous day to benefit from the dividend payment. If you find this video useful, please like it, leave your comment below, share to a friend and subscribe to our channel. See you next time.